Welcome to episode 77 of Kontrarian Korner. I'm Ben Kellerin. Today we have a very special first-time guest on, what I like to think of as a young Rudy Havenstein, for anyone familiar with FinTwit. But it's very sharp, got a lot of interesting charts, a lot of interesting data. I think it'll be a fascinating conversation on current events, what's going on in markets, what's going on with rates and SOFR and some of the other stuff he's watching right now. But Robert, thanks for coming on.
Yeah, thanks for having me. Young Rudy Harvenstein is quite the compliment, so appreciate that.
Yeah, I actually had him on the podcast recently. I was mentioning to him that we should do a three-way podcast at some point in the next couple months if both you guys are up for it. But we'll have to table that for a later date. But so for anyone that's not familiar, Robert has got a great Twitter account, also known as Infranomics. And so we'll be going through some charts. And if you guys are listening on Apple Podcasts or Spotify, you might want to switch over to YouTube or the Substack where you can get some of the visuals. But I know we were kind of chit-chatting before, and you said that you wanted to start with kind of SOFR rates and some of those high-level topics because that's what's been on your radar over the last several weeks, really. Why don't you lead us off there, and we'll see where it takes us.
Yeah, so going back to really late July, early August, when Scott Bessent came out and announced that they were going to rebuild the TGA, the government's checking account, rebuild that from 300 billion up to 850 billion was the original target. We're at $1 trillion right now because of the shutdown. That was kind of what piqued my interest into kind of starting to examine it. That was back like early August, I want to say. And the reverse repo was, I don't know, called 20 billion. And I was thinking to myself, well, if it's the reverse repo, the buffer, the shock absorber for liquidity is gone. It's basically empty. I mean, 20 billion at the time, you're talking about a rebuild of $500 billion. Where's that going to come from? Well, it's got to come from bank reserves. Of course, we're running a massive 7% of GDP pro-cyclical deficit. So that's another funding strain. You also have quantitative tightening by the Fed, which is just as QE is stimulatory and positive for liquidity. QT is the opposite. So you have Fed QT, you have massive deficits, you have a reverse repo or a buffer, shock absorber that's basically empty. Your truck is bottomed out and you're about to hit another pothole, deeper pothole. And I was saying to myself, this has the potential to cause a liquidity event similar to 2019. So I did a couple of videos. My channel focuses on like the average person that doesn't understand any of this stuff. So the first step was to kind of explain 2019 repo rate crisis and what that was. So kind of started there and just kind of dove deeper and deeper into it. And sure enough, like we've seen exactly that.
Yeah, so you kind of mentioned the SOFR and financial plumbing aspects that you've been paying attention to, but what is kind of changed maybe in the last couple months that's been one of your main focuses recently?
Yeah, so back then, of course, early August was back here. There were already signs of kind of liquidity issues, strains, nothing major, but certainly something that was notable. And I think it's helpful when looking at these various SOFR spreads. Everyone, of course, is talking about this now, but I think it's helpful to look at moving averages. So I'll take off the day-to-day volatility so we can see the moving average. And it's just been going straight vertical since arguably kind of late July, early August. This is kind of when I first started to take notice of it. And of course, it's normal to have funding stresses at the end of the month, at the end of the quarter. That is normal. There's window dressing, there's tax deadline. So like mid-September, we saw funding strains. But what we've been seeing recently is not only an increase in the SOFR spreads, but an increasingly frequent usage of the standing repo, which is the Fed's emergency liquidity backstop. This is the opposite of the reverse repo. The reverse repo, again, a storage tank for excess dollars and a buffer that can be tapped, basically. The standing repo is the exact opposite. This is where there is a shortage of liquidity, of actual dollars, and banks and dealers and firms need to go to the Fed for emergency cash. And so that SRF usage we can see here in green lines. This chart goes all the way back to like late 2022. And of course, it was not used, or it was not used in any meaningful amount over $1 billion. And we're seeing like increasingly frequent usage of this emergency liquidity backstop. And of course, we are seeing SOFR spreads blow out. And of course, over the past 6 days, we had SOFR, again, kind of the actual realized, it's a volume weighted median cost of capital. The most important price of all within our financial system is the price of a dollar itself. And that price, SOFR, has been moving higher relative to what the Fed would like. And we're seeing these kind of elevated funding strains. They are coincident with an increasingly frequent, increasingly large usage of the Fed's SRF. And of course, it's coming at a time where the government shut down. The TGA blew past the target of 850 billion and is now at $1 trillion. So what that means is, again, the higher the TGA balance, that is money that is not flowing in the banking system, in the real economy, in the financial system. That is money that is sterilized in a checking account, basically, that the government has at the Federal Reserve. So you kind of put the whole picture together, and it was starting to become worrisome. And by the way, we had the SOFR, the actual cost of overnight capital, go above the discount window rate. Now, why is that important? I can pull up hopefully an easy illustration for this that people might be able to make more sense of. The discount window rate, or the standing repo rate, the interest rate on those overnight loans, is in blue on this chart. And that is the upper bound for the Fed. So the Fed doesn't actually set one interest rate. They set a corridor of interest rates. Now, for the unsecured side, that is the Fed funds, that corridor is IORB, or interest on reserve balances, and then the reverse repo award rate as the floor. And this is the Fed saying no matter how overabundant dollars get, the reverse repo we will always buy them right now at 3 3/4. Discount window, or SRF, that is the Fed saying no matter how scarce dollars get, we will always sell them. Right now it's at 4. And what we've seen just yesterday, of course, this came in to 4%. So we are right at that upper limit. But what we have seen over the past couple of days is that the SOFR, the actual realized cost of overnight capital, these overnight secured loans, has been above the discount window rate, has been above the Fed's upper bound of their corridor. And of course, this is an indication that the Fed is maybe starting to lose control over the most important price of all, which is the price of a dollar, the interest rate on one of these secured overnight dollar loans. And as we can see from this and the prior chart, SOFR spreads have just been blowing out. Of course, there's day-to-day volatility. We have seen also funding stresses on the unsecured side in the Fed funds market. So SOFR is about $3 trillion per day. That is secured overnight lending. Fed funds, that is an interbank unsecured lending overnight. And that is also moving higher relative to some of the Fed static interest rates, like the RRP, which again is that floor in the corridor. The Fed funds has actually moved higher by 4 basis points relative to the reverse repo. And this is something that, again, everyone is kind of finally starting to talk about, but these stresses have been pretty evident, to me at least, going back to August. They're just getting worse. And you had Fed Logan, come out, and Jerome Powell as well, talking about restarting QE. Of course, this all happened back in 2019. We know what they did, which was increase bank reserves. Cutting rates is not really the antidote here. You got to inject liquidity. And the way you do that is through QE, where the Fed prints bank reserves out of thin air. The way they get those to the banks is by purchasing financial assets like mortgage-backed securities, U.S. Treasuries. And so now the bank has cash, and the Fed's got securities. So that's how they fixed it in 2019. And if this continues to remain a problem, and as Fed Logan said, does not reverse itself, it is not temporary. I would argue it's been going on for 2 months now. But if it is not temporary, Fed Logan said Mary Logan said, we're going to have to restart QE. Jerome Powell gave a speech. They normally don't talk about this stuff. This is normally super wonky, super nerdy, super boring. No one pays attention to SOFR or repo markets or any of this financial plumbing stuff. But the fact that both of them have come out and made comments about the elevated strain, I think is important. And by the way, this has been happening at a time where it is not month end, not quarter end. So the various vertical lines here, we can see SOFR there are funding strains at month end and at quarter end. And we can see, spikes in either in the upper pane here with SOFR, you can see a spike in the interest rate at month end and at quarter end. And down here, we're looking at a spread, SOFR minus the reverse repo. That is normal during month end, during quarter end. However, what we have been seeing recently has been throughout, and not necessarily month end, quarter end. For example, today is November 5th, and so we're looking at SOFR data for November 4th. That is not month end, that is not quarter end, and yet SOFR is at the upper bound of the Fed's range and has been above that upper bound for 6 consecutive days leading into yesterday. So there's, in my opinion, undeniable funding stress in repo markets in these overnight secured and unsecured lending markets.
Yeah, it's pretty interesting. It's something where I know the basics, but it's also like not directly in my wheelhouse for stuff like this. So I guess the follow-up question to that is, what happens if it kind of keeps getting worse from here, or like what is the response if kind of the funding stress you talked about doesn't go away?
Yeah, so 2019, there were similar signs. It was actually a very similar dynamic. The deficit was not quite as large, but you had the Fed engaged in quantitative tightening, bank reserves, as we can see here in green, inverted. So as this line is going up, that means bank reserves are going down. The scale is over here. So the Fed was engaged in quantitative tightening, bank reserves were falling, and liquidity was tightening. You were starting to see signs of stress, all the same spreads I mentioned, SOFR, discount window rate, and these sorts of things, SOFR minus RRP. You were seeing stress, and it culminated basically in the mid-September 2019 repo rate crisis. Now here we're looking at a 10-day moving average. So the fact that it moves so much higher in such a short period of time, for a 10-day average, that indicates the underlying metric actually moved even much more significantly. I think intraday SOFR went about 900 basis points above the Fed funds, 9%. This would have arguably been worse than the GFC if we had truly free markets and no Fed and kind of this utopia we dream about. It would have been catastrophically bad. And what it is signaling, just in simple English, is scarcity of dollars. You just very simply, if you're the only guy on Wall Street that has $100 billion and everyone is coming to you because they got to pay taxes or window dressing at the end of the quarter, you're the only guy with $100 billion. You get to set a very high price. Well, that is SOFR. That is the actual cost of loaning your $100 billion out. You are the only firm on Wall Street. You get to set a very high price or interest rate. And so what it is indicating fundamentally is a scarcity of dollars, or scarcity of dollars willing and available to be loaned out to other counterparties. And so that can only be fixed by one thing, which is an injection of bank reserves and QE in the form of liquidity. And sure enough, that is what we saw. Bank reserves started to go up. Again, this chart is inverted here. From the repo rate crisis, we can see bank reserves went from a low of about 1.39 trillion to about 1.6, 1.7 trillion. And then coincidentally, we had a major geopolitical event that just so happened to necessitate printing a huge amount of money, and bank reserves really went up.
Yeah, that's it's pretty interesting to think about, because when I kind of see what's going on with rates, and maybe we can get into rate cuts and what's happening with the long end of the yield curve, and right, I kind of just use TLT as a proxy for it, but we could also talk about gold and some of the stuff that you're seeing there. But what's your kind of view on where rates might be headed over the next 6 to 12 months, and then maybe long term? And what's your view on right, debt deficits, all this other stuff that people talk about, and look at the long end? Because like you said, everyone can wish that we had free markets, but we don't. And that's one of the things I've started to realize over the last couple of years is you don't have free markets in stocks, commodities, rates, any of these other areas. So what's your kind of view on the long end of the curve, where it might be headed as far as interest rates?
Yeah, so I mean, you would think TLT and the long end should go higher or lower in terms of price, higher in terms of yield. That's kind of been my view for I don't know 2 or 3 years, but I'm coming around to the idea that maybe the long end doesn't, maybe rates don't really blow out as much as we think they should. We are seeing that in UK, in France, to some degree in Japan. They have come in a bit at the long end there. But whether or not we see it in America is a different story. We are definitely already seeing it in UK and France, which I would argue are in the early stage of a debt crisis, the two of them. In Germany as well. I mean, long end rates across the world are just up and to the right. Now in the US, you compare US rate long end rates, and they actually look well contained compared to Japan, France, Germany, UK. So, whether or not we really get that kind of blowout in terms of US, the 30-year yield, I'm kind of starting to moderate that view. I think that they have a lot of levers that they can pull. We know activist treasury issuance started under the last administration by Janet Yellen. This accounts for a significant amount of yield suppression in, say, the 10-year yield. I've seen estimates all the way from 50 to 100 basis points of yield suppression from activist treasury issuance, which simple English, this is where they issue, instead of spreading out the duration across many different tenors, you just issue in short-term debt instruments. These short-term debt instruments being less volatile, more readily levered, they're more cash-like, they're more money-like, they're more liquid. And by artificially reducing the amount of supply of 30-year bonds, if demand stays constant from, say, pension funds, there are mandated buyers, basically. There are always going to be some demand for 30-year bonds. Well, if you reduce the supply and demand stays constant, the price will go up. And so there's kind of a mechanical, artificial manipulation in the price of these 10, 20, 30-year debt instruments. And they can always reduce that even further. There's nothing to stop them, arguably, from reducing it even further. Today, by the way, we just got the QRA. So I was just looking through that. They're noting that maybe in 2026, they might actually be increasing the size of some of those auctions. So, whether or not they pull the lever, it exists. And of course, there's SLR tweaks, and there's all sorts of wonky levers that they can pull. And I've kind of come around to the view that maybe the 30-year yield just kind of maybe stays in a bit more of a range rather than having long end rates blow out. But we are certainly seeing it in France, UK. Right, it is happening. The kind of debt crisis sort of thing is happening. It's just not happening in the US yet.
Yeah, well, my long-term view on Europe is very bearish. I think the EU is going to collapse, and I think the euro goes up in smoke with it. But that's like a 5-year, 10-year thing. But anyway, one of the things I wanted to get into is some of the gold and inflation stuff, but also how it ties in with populism and politics. And obviously, we had Memdani win mayor in New York, which I'm sure some people are not thrilled about. I would guess most of my listeners are not all that excited, but I mean, there's a reason not to live in New York. But point is, there's rising populism and other forms of politics, and I think we're getting close to what I like to call fix-it politics, where people don't really care about the procedures and what's legal, or all these different administrative checklists. It's right? I think it'd be great if the U.S. had a Bukele type figure where it's you go after the problems and you solve them. But what's your kind of view on how inflation and politics, gold, all these things kind of tie together to where we're at politically and some of the changes you see there?
Yeah, it's an interesting time. I'm a big fan of Peter Turchin. Many people know Neil Howe and Fort Turning. I actually think Peter Turchin is better. So I'd highly recommend like Ages of Discord and Peter Turchin's work on that. But the kind of Fourth Turning demographic sort of structural demographic theory says that this is kind of to be expected. We see more political volatility, more ideological polarization, more racial polarization, more income inequality. Income inequality today, by the way, 2025 is even worse than it was in the Gilded Age. And so, it's kind of, at least according to that structural demographic theory, it's almost to be expected that we see figures like Mamdani and more populism. I would argue Trump really started that. And it's funny because I remember 2016, or maybe I guess it would have been 2015, there was Bernie Sanders, Trump, and all these, kind of establishment folks in CNN and MSNBC and stuff were going to the Rust Belt. They were interviewing people, who are you going to vote for? And these blue collar guys were like, I don't know, kind of between Trump and Bernie. And it was like blowing their brain apart that they were between, because in their eyes, they saw it as Bernie is the extreme left and Trump is the extreme right. And didn't realize.
Trump is just the 90s Democrat, but go on.
Yeah, exactly. This is what I always say as well. Like he, and you look at his cabinet, you look at his administration, Elon, Democrat, Tulsi Gabbard was a Democrat, RFK, and he was a registered Democrat for decades. And his policies are what the Democrats back in the 90s. I remember the Seattle WTO protests, right? The turned into like a full-scale war in the streets of Seattle. That was the left. That was the Democrats opposed to globalization. And where have those guys gone? Now they're whining on TV about tariffs. But I guess that's a separate story. We've seen a shift, an inversion of the political parties, without a doubt. The Dennis Kucinich Democrat, right, from 99, early 2000, is now a MAGA Republican. It's bizarre. But yeah, the way it ties into financial markets. So kind of ask yourself, okay, well, if we're going into this period of rising populism, which when you have wealth inequality at levels not seen since the Gilded Age, where wealth inequality was so bad, we named an entire era of American history after it. And wealth inequality today is even worse. When you see kind of the obscene wealth concentration that we see today, when you see the hyper-financialization of the U.S. economy and this kind of financial nihilism and this gambling mentality for Zoomers, the only way I can make it, the only way I can afford a middle-class life and buy a house is to hit a 10,000x on some meme coin. We see, a huge surge in zero DTE, options trading, all these various different things. It's reflective of an underlying sickness within the structure of the U.S. economy, not only domestically, but I would argue globally. There's significant issues with the dollar, reserve currency status, Triffin's dilemma, Dutch disease, that has led to this hyper-financialization, which has therefore third order effect led to the wealth inequality that we see today. The other side of a current account or trade deficit is a capital and financial account surplus. And right now that's about $1 trillion per year that mechanically must flow from foreigners into U.S. financial assets. It's one big mess. And fix-it populism is kind of one answer to this mess. I mean, I could talk about the mess for 3 hours. And the problem is you have a mayor in New York City, right? Some one municipality. He's not going to be able to fix Triffin's dilemma. He's not going to be able to fix hyper-financialization. It'll fail, but it's understandable. I think that I was watching last night, pretty tired, but I was watching last night, and I think that the left is finally waking up to the political recipe that is going to work. It's kind of interesting to me that the opinion on the other side is kind of dismissive and celebratory almost. Oh, now we're going to have a socialist to make fun of. I think they're severely underestimating for 2028 the potential for AOC presidency or whoever it may be. But to translate it into markets, I think that the issue with populism is by definition, and Chuck Carson talks about this a lot, kind of way out ahead of it back in the early part of the year. But he noted that you look at the last time the U.S. had populism, it was 65 to 82. Well, if you look at the S&P 500 from 65 to 82, this was a great society and so on and so forth. Of course, the Nixon shock in 1971, you had a monetary reordering, which, by the way, Scott Bessent said in June of last year, 3 times in his speech at the Manhattan Institute, that there would be a global monetary reordering and he wanted to be a part of it. You had that in 1971. You also had populism, 65 to 82. You had some populism. So large deficits, large fiscal spend. And, the S&P 500 basically went sideways for 12 years in dollar terms, right? But you look in gold terms and it fell by like 90%. So if you were invested in the S&P 500 in dollar terms, sure, over that 12-year period, over that decade, call it, you didn't make any money, you didn't lose any money. But the dollars that you had left purchased a significantly smaller amount of real goods and services. And I think that, it's kind of what we're probably going to see given, tying in the debt and deficit, the kind of long end rates and interest expense and kind of tie it all together. And I think we're in for, I don't want to call it a big print. I don't think that it'll be like a catastrophic sort of thing. I kind of see it as the pain trade. So societally and kind of in general, the pain trade is like, I don't know, 5-6% inflation for a decade. And negative real rates, of course, we know that that's the direction they're trying to take things, more bill issuance, which I mentioned earlier, more cash-like, more liquid, more stimulatory, more inflationary. Negative real rates, I mean, we have Myron talking about the neutral rate being at 0.5%. This is absurd. Right, we've had rates at basically 4.25. We have inflation with a 3 handle. We have assets at all-time highs. How are you going to say the neutral rate's 0.5%? But look, it is what it is. It was baked in the cake. And so, due to the debt and fiscal of the past 5-6 years. So it's coming, negative real rates, heavy bill issuance. But the consequence, the release valve, is a weaker dollar, more than likely. Weaker dollar relative to other currencies and a weaker dollar relative to gold. I think it's really helpful for people to, probably your listeners are proficient at this, but I always tell people you need to look at gold as an FX pair, no different than dollar yen or dollar euro, euro dollar. It's the same thing. You're looking at gold dollar. Well, the other way to interpret gold price going vertical is the inverse of that, which is the dollar denominated in gold is crashing. Of course, gold has had a bit of a pullback, but the move in gold, I think, signifies is front running the reality, that fiscal reality, that negative real rate reality, that fiscal dominance reality, that inflation reality, and I think it's a huge red flag that policymakers are not paying enough attention to.
Yeah, it is. It is funny to see what's going on with gold, and I understand there are different drivers for it, but when you see that and you see what's happened over the last 5 years, like I think we're already kind of in it as far as like real purchasing power being chipped away over time. And I think, I mean, I don't want to get sidetracked on the whole CPI, but that number is not accurate for like actually gauging what expenses are for certain things. It's just not. And so, right, if you think we already have negative real interest rates, right, what happens when inflation really kicks back up like it was in 21, 22, where like even CPI was saying what 7, 8, 9% depending on the time, right? So I think that's
you've tied the hands of the Fed. and it started under the last administration, right? By shifting your debt issuance into bills, all this whining about Fed independence is hilarious because under the last administration, Janet Yellen started activist treasury issuance and shifting all the debt into short-term bills. Well, what that does is it ties the hands of the Fed, because if there's an inflationary impulse, like for example, if inflation goes from 2.5 to 3% over the past 5 months going straight up, the rate of inflation has been going straight up for 5 months, highest going all the way back to January. If you have an inflationary impulse, say next CPI print is 3.5 or something, the Fed can't raise rates to respond to that. That is fiscal dominance. Because by raising rates, okay, well, you blow out the interest expense from 23% of tax revenue to 28%, right? And that blows out the deficit, and that increases treasury issuance, right? You get higher yields, higher interest, and you go into a debt spiral. So the problem now is that they won't be able to respond to the next inflationary impulse because we're in fiscal dominance and we're financing the government in these payday financing overnight cash markets.
Yeah. Well, I mean, all that stuff is accurate. And one thing I'll add is, right, oil's at $60 a barrel and inflation's at 3% if you, right, want to take their numbers for what they're worth. But point is, right, if oil's at 60 and that's where inflation is, right, my long-term view on oil is that we're going much higher. But
Me too.
Whenever that happens, I mean, part of it is the currency it's denominated in, just like gold. But I think that's where inflation really, we kind of see the second wave, probably of 3 if we follow past cycles, maybe starting sometime in the next 12 months. But we'll see on that. One of the things that I did want to get into is some of the charts you put up on like the wages as a percent of GDP, wealth inequality, and some of those, because the visualizations there are pretty mind-blowing when you think about it. And you kind of look at that and asset prices and other different things, and it kind of goes into what I've kind of seen people talking about in the past is like how younger generations effectively are subsidizing older generations with Social Security, Medicare, Medicaid. And at the same time, you have wages where they are, asset prices where they are, and it's not a good recipe as far as looking for like political stability and economic opportunity for the younger generations.
Yeah. So here we're looking at various different metrics as a share of GDP.
Yeah, so we had some trading view technical difficulties, but one of the things we wanted to get into was like the boomer retirement complex and looking at wages, Social Security, Medicare, Medicaid, all these different things, and also asset prices kind of, and how that is playing a factor in some of the political stuff you see going on and all that. So if you want to click on that image, you can show everyone what we're looking at as far as Social Security, Medicare, and wages. And maybe if you have some comments on that, we can go into that for a couple minutes.
Yeah. So in white, here's the average per capita wage as a share of GDP. Now, this does not account for population growth. I would argue for the average American that's struggling right now, working 3 part-time jobs, they don't care that the population has grown. What matters to them is the per capita wage. So here, I've run the calculation, total wages, it's the same story. It's just less severe. But here we're looking at average per capita wage as a share of GDP, and it's been down and to the right relentlessly going back to the mid-1960s. However, homeowner equity as a share of US GDP, and again, what we're looking at here is a numerator and a denominator. The numerator being homeowner equity, and then the denominator being US GDP. So what you're looking at is the relative rate of change between 2 different metrics. In this case, homeowner equity and then GDP. They're both going up and to the right. Here, the blue line is showing the degree to which homeowner equity, the numerator, is going up faster than GDP, the denominator. And what we can see is that it has gone from about 45, 50% all the way up to 115%. So that is the main, talking about the boomers, this is the main asset, right? The average boomer is very much like the K-shaped economy kind of today. It's the same way with the boomers. The average is pulled up by the upper leg of the K. The upper leg of that K within the boomers is obscenely wealthy. There's no doubt about it. But the lower leg of the K is actually not nearly as wealthy as a lot of young people think. The median boomer is actually not very well off at all. And they only have about 50.
Net worth is tied up in their house, I would assume, for a
which
lot of
is
those.
Exactly right. So the lower leg of the K, the vast majority of the wealth is in the house. And of course, those have gone up as currency debasement, monetary inflation. The house has gone up in value, right? 8x, 9x, 10x from when they purchased it. They purchased it with leverage, aka mortgage. So you have leveraged exposure to currency debasement in the form of a house. And here we can see that has been outperforming the overall economy. That homeowner equity has been growing at a faster rate than the overall economy. Social Security and Medicare outlays, these are their benefits, if we're talking about the boomers. And those have grown as well from about 3% of GDP to now about 9-10% of GDP. So what that means, again, Social Security and Medicare have been growing faster. The outlays, the benefits, the cost for the spending has grown faster than the overall economy. And so what you get, if you're a young person, you are the white line. Oh, and by the way, you have $200,000 of student loan debt that you have to repay as well. You probably have credit card debt. That credit card debt is floating rate, and we have had this huge surge in interest rates. Right, kind of go down the list. And you mentioned inflation earlier. I just want to point out, I ran through multiple AI models. I said take the CPI formula and replace OER with the actual monthly mortgage payment for, I want to buy a house and the interest rate matters. And so I was curious, what would inflation be if you just replaced OER with the actual monthly mortgage payment? And it said from 2020 to 2024, it said about 115%. Because of course, the cost of housing is one of the most important costs for everyone. And for me here in SoCal, the income needed to qualify on the same house tripled in just a couple of years. And that, shelter being a large outlay for individuals, this has put housing completely out of reach. Like what young person's wage has tripled. And so their assets are outperforming GDP. And of course, this is to say nothing of the S&P 500.
Yeah, so before we had some screen share issues, we were talking about S&P asset valuations and how some of the boomers have benefited from that. But I think one of the other things that I think would be kind of the best place to put a bow on it is what's happened to average wages in terms of gold, which obviously preserves real purchasing power over time, and how that's kind of led to deaths of despair and some of this other stuff you've talked about.
Yeah, so this chart we're looking at, average hourly wage in gold terms. Again, both of these are going up and to the right. The issue is at what rate, what relative rate. So wages in dollar terms, if you look at just the average hourly wage in TradingView, is up and to the right. It looks great. This even looks exponential. But the problem is that the rate of increase is much slower than GDP, than the money supply growth, than M2 growth, than gold's price appreciation, which, like you said, is a good measuring stick over long periods of time for currency purchasing power or currency debasement, monetary inflation. And so here we're looking at the average hourly wage in gold terms. Very simply, if you work an hour of work on average, how many ounces of gold does that earn you? And we can see it's at an all-time low. By the way, the birth rate just hit an all-time low. It's probably not a coincidence that wages as a share of GDP have been plummeting. Wages, personal income as a share of M2 money supply has been plummeting. Kind of average hourly wage divided by gold. I mean, you go down the list in that tab that you're looking through, that thread. It's all painting the same story, which is the economy, that one. Labor force participation rate's been going down for 25 years, peaked in 2000. Real personal income, the real purchasing power of personal income, right? You have to look at it relative to the money supply. Of course, personal income is up and to the right. you have to look at the purchasing power of that personal income by dividing by M2, and it's down and to the right. Average hourly wage in gold terms down and to the right. There's another way of thinking about it, the percentage of the loss of purchasing power. It's all the same story. In Deaths of Despair, I have been talking about this for a while now. I thought that it was due for an update, so I went and updated the Joint Economic Committee's Deaths of Despair chart that they had provided in their report to the Senate. Anything past the red line is from 2019 onwards. So it was already looking insanely bad. You already had Deaths of Despair above the rate that they were during the Great Depression, like double the rate of the Great Depression. Now, with 2020, I think the most updated was 2023 data that I was able to find from the CDC, and I provide the citations. It is now triple the rate that it was during the Great Depression. And a large part of that is drugs, fentanyl, which is being imported by a very particular country as a part of this kind of asymmetrical warfare. They have a different way of looking at the world, and then it's coming in through the southern border to a large degree and killing 250,000, mostly young Americans every single year. If you total up if you take that Death of Despair rate, because it is a adjusted per capita rate, that is not the gross figure. That is a per capita rate. If you take that rate and extrapolate it out to the population, 250,000 Americans are dying every single year from deaths of despair, otherwise known as economic hopelessness, deaths of economic hopelessness. So yeah, it's a crisis, and it all lines up to paint the same picture, which is there's a bunch of deeply rooted, fundamental systemic issues with the U.S. economy that took decades to develop and are not going to be fixed in a month, in a year. It's going to take a decade, if not longer.
Yeah, so that's an interesting topic, because I kind of mentioned fix-it politics, and you think it's going to take a long time to fix. If I wave the magic wand, so to speak, and put you in charge, what are the fixes? Is it like really cutting back on immigration, which starts to fix real estate prices? Is it really, and probably wages too, but is it really locking down the border and focusing on drugs? Because I know, like, whether people will say it or not, like, the alphabet soup agencies have enough information, and if they wanted to, they could stop the flow of fentanyl and other drugs across the border, right? So if I wave a wand, put you in charge, what are some of the fixes that you would look at and say, hey, if we implemented these, we could make a significant change for the better for the U.S.?
Man, it's so hard. There's so much that needs to be done, in my opinion. So yeah, I would say, stricter immigration policy. What both parties have done for decades, both parties, started with Reagan, was to increase the labor supply in order to save the bond market, to save the bond bull market. The bond market had kind of melted down, right, in the mid to late 70s into the 80s. They needed to save the bond market. They saved the bond market for decades by increasing the labor supply. Demand was growing, and the labor supply was growing even faster. So mechanically, what does that mean? That means lower wages. Well, lower wages means lower inflation. Lower inflation is good for the bond market. And so that was the priority that they set. They wanted to prioritize the bond market above the needs and the wages of their people. So they increased the labor supply. And both parties did that for many decades. I think that, you reduce the labor supply, which is starting to be done now. And as long as demand doesn't fall off a cliff, for example, due to productivity increases from AI and robotics, which I think we're starting to see. I had that S&P 500 job openings post that went super viral. Like, maybe it's starting to happen with AI. I don't know. I just thought that post interesting, or that chart. If demand starts to wane and you are reducing the labor supply, you have to make sure that the supply side is being reduced at a faster rate than demand is falling if you're trying to boost wages. But at the very least, you could stop increasing the labor supply, both legal and illegal, because it affects both sides, right? The blue collar guy and the white collar guy the middle class sort of guy. Like they're both being affected either by the H-1B or by illegal immigration. It's affecting both sides. So that's one start. Another start, of course, is to admit the reality, which is that the dollar is grossly overvalued, both in terms of real goods and services and in terms of other currencies. China for a long time has been, manipulating their currency. This is, well documented. This is not controversial. And this has helped boost their kind of overcapacity, export-driven, export dumping, sort of overcapacity approach to their economic model. And it's worked really well. They have ascended, both Japan and China, taking a merger of state, of industrial and trade, fiscal and monetary policy. You combine all that together, you coordinate it. Japan and China, it led to the most, these countries were ascendant. Japan incorporated. There were fears Japan was going to overtake America. So I think that you look at China and the success, arguably, of that economic model, and it's hard to discount, right? Like I wish that free markets were, that looking through the data, that it would be the libertarian approach is the most prosperous for the average American. But like, that's not what I found. What I found objectively, and I came from that camp. I would probably call myself a libertarian from like 2017, 2018, kind of up until recently. But like looking at the data, spending hours every day looking through TradingView and reading papers and whatnot, like, it's not what you find. What you find is Japan and China, which merged trade and industrial, fiscal and monetary policy. That was the recipe for ascendancy in economic terms. So I think that we're starting to see that. You see nationalization, equity stakes, and critical companies. We're already starting to see that kind of starting here. I think that is one way, or one of the ingredients in the recipe. I think you got to admit the issues with the dollar. I think you have to admit Triffin's dilemma's reached, end times. We have stage 4 Triffin's dilemma. And so I think, that requires a weakening of the dollar relative to goods and services. The debt has to be devalued in real terms. So, versus gold as a measuring stick versus things like Bitcoin. Much weaker dollar, much higher price. And of course, this is not painless. Like this is going to hurt. The problem is we have tried to defy financial gravity for decades. And eventually, your jetpack runs out of fuel, like, and gravity starts to take hold. So, what needs to happen is not going to be painless in the first wave of it, the first phase. But the debt has to be devalued in real terms. In order to get the government size and the fiscal under control, and the kind of horrible strain that the interest expense is 23% of tax revenue. Like it's insane what the leverage we built up and through decades of horrible fiscal policy. That has created a crowding out of productive investment. You have to deal with the debt, and if nothing else, for the interest expense alone. So, devaluation, historical average back after the Great Depression, 40% of M2 had to be backed by gold. That was a decree by the president. Well, that would equate to about $30,000 per ounce gold. If you look at debt, the backing of foreign held debt, as the foreign held debt backed, what percentage is backed by our U.S. gold reserves? Again, the gold price you arrive at is like $29,000. And that's just to return to a historical average. I'm not the first person to run that math. And so, I think that is part of it. But I think that gold devaluation, if we just use gold as a measuring stick, what needs to happen is a balance of payments valuation needs to return to currencies. This is how it functioned for hundreds of years prior to kind of the modern system. And that means a much weaker dollar. If you look at the purchasing power parity valuation of the US dollar today, 2024, it was even more overvalued than it was going into the Plaza Accord in 1984. When the DXY index was like 160. The Dixie at 105 was more overvalued on a real purchasing power, on a fundamental basis, was more overvalued than 1984. And that, we know what happened with the Plaza Accord and the weakening of the dollar, the severe weakening of the dollar. But this is just to return to a fair valuation. This is not to say the dollar needs to be artificially weakened beyond its fair value. It has gotten so grossly overvalued that in order to return to kind of a fair valuation, it involves not only a devaluation versus gold, say, but also a devaluation versus the yuan versus the yen. I mean, purchasing power parity for the dollar yen is like 110. The dollar yen should be at like 110 on purchasing power parity basis. So, some of these currencies, foreign currencies, are undervalued and our system is overvalued. I think you also look at the tax structure. Why is it the capital is taxed at a fraction? If you work for a living, why are you taxed at 2 or 3 times the rate that some guy with $100 million moving numbers around on a brokerage? Why, if you work for a living, you're some blue collar electrician, why are you getting taxed at double or triple the rate of, depending on how much you make, of some guy just moving hundreds of millions of dollars around on Wall Street? That makes no sense. We have prioritized capital over labor. If you look at the S&P 500 as a proxy for kind of that prioritization, the S&P 500 has grown about 9 times faster than the average hourly wage going back the past 50 years. The average hourly wage right now is about $32. You do the math. The average hourly wage, if it had kept up with the S&P 500, and that's not even total return, that's just the underlying S&P index. Total return would be even worse, including dividends. So, prioritization of capital over labor, that has been the model for 50 years. We have to end that. How exactly that looks, you end the carried interest tax loophole, you start taxing capital gains at a rate more equivalent to labor. There's a lot. There's a lot. I think those are probably the major points that would be a good start. And look, this administration in the early stages, it was looking promising. Besant talked about the dollar, talked about the issues with the debt, talked about monetary reordering, and that was back in June of last year. And early part of the administration, he was saying all the right things. We're going to prioritize, Main Street over Wall Street. Wall Street's won for 5 decades. It's time for Main Street. He's saying all the right things, but then the Liberation Day chaos, right? Trump imposes his characteristic, his signature policy of tariffs. And due to the fact that we have run utterly insane trade deficits and therefore have accumulated a net international investment position of negative 95% of GDP, meaning foreigners own on net about $27 trillion more of US assets than we own of theirs. They sold 20, 30, 40 billion of US treasuries, caused treasury yields to go vertical. 10-year yield went up, 80 basis points or something in a couple days. And caused Trump to capitulate on his most signature, his core policy of tariffs. It caused the first taco, the first pivot. We have lost sovereignty. We have become so hyper financialized as a result of these perpetual current account deficits that, again, the other side of that is capital and financial account inflows that benefit financial asset holders. We know the top 10% of income earners own 93% of the U.S. equities. So this is a hugely disproportionate benefit to the top 1%, the top 10%. They have $1 trillion per year bid from foreign capital inflows in things like corporate bonds, real estate, U.S. treasuries to a large degree, corporate equities. I totaled up going back to 2012. I went through all the BEA data and totaled up how much foreign direct investment. Again, as a mechanical, just for people, you have to balance a $1 trillion per year trade deficit, current account deficit somehow. Well, the way you balance it, it must net out to zero, is a mirror image, right? So if you're running a huge trade deficit, the other way of putting that is you're running a $1 trillion per year capital and financial account surplus inflow. Well, that is kind of broken down by category, and the foreign direct investment in real estate alone over the past 15-ish years equates to about 700,000 single-family homes. That's also including portfolio investment into REITs and mortgage-backed securities. That's a huge. When we talk about housing crisis and the housing affordability issue, 700,000 single-family homes worth of real estate were purchased as a direct result or as a way to balance these insane trade deficits. So we have to reindustrialize the wage component. Look, AI, automation, and robotics, it makes it hard to say, okay, we need to reindustrialize to boost blue collar wages because it's at the same time as AI and robotics. But at the very least, we should not rely on arguably an enemy, an adversary, a competitor for 65% of active pharmaceutical ingredients, for 95% of these rare earth minerals, right? Like, just from a national security perspective, we have to reindustrialize, even if AI and robotics, automation doesn't necessarily boost wages. Like, you still need to do it from a national security perspective, in my opinion. You shouldn't. Your industrial base. I mean, we lost a proxy war to a country with 1/12 of our GDP because we can't make anything anymore, because we have so totally hollowed out our industrial base as a result of this structurally overvalued dollar, which again has disproportionately benefited financial asset holders, led to insane hyperfinancialization of the U.S. economy, and led to insane wealth inequality. It's a mess, and it's not going to be quick, it's not going to be cheap, and it's not going to be painless. But like, at a certain point, the first stage or the first step, you have to admit what the problem is. And I think, to some degree, that's starting to be done in certain corners. But largely, I think that, 99% of policymakers, and certainly of the general public, are kind of blind to all this stuff.
Yeah, I think that's definitely true. One of the things I was thinking about as you were kind of talking about free markets and all this other stuff is, like, sounds nice in theory, but if you look at the real world, they only exist in textbooks. So we'll kind of see
how do you compete, right, against a country like China that can afford to go, look, EVs, right? EV cars, that is a national security imperative that we corner the market on EVs. We are willing to print $1 trillion per year to subsidize. We don't care if the companies make profit, right? We are going to print $1 trillion a year, $2 trillion if we have to subsidize that critical, what we deem critical industry, to make sure that we gain market share. How do you compete as a free market? How do you compete with that? How do you compete with a country that manipulates their currency to be so obscenely undervalued that their goods are so much more competitive than yours on the global stage? I mean, the dollar yuan cross rate is like insanely out of whack. So yeah, that's the other question, right? Free markets might theoretically work in a country, but they don't work in the global economy. I've pressed some of the biggest, kind of very libertarian sort of economic folks. I've pressed them. How do you deal with this dollar issue? Triffin's dilemma, Dutch disease. How do you deal with countries like China that manipulate their currency, that subsidize certain industries to insane? They never have an answer.
Well, yeah, I think the whole libertarian thing, I think if you're looking at the world in a similar way to, I think, a lot of us, everyone kind of goes through that where it's like, oh man, it'd be nice if people behaved and acted this way. And I've kind of realized it eventually is like the libertarian to right-wing pipeline is basically undefeated, because you kind of see all these different things. The only way a libertarian society or like free market type structure works is if the only people who can vote are, this is a joke from a friend, but the only way that works is if the only people that can vote are like 130 IQ white dudes, right? Point is, like, I think there's a lot of things that you've hit on that are people are starting to talk about more, which I think is important. And I think the fixes are not actually rocket science, and it's just a matter of political will and getting the right people in the right seats, and basically pushing for some of these changes that we know need to happen. So I don't know if you have any last thoughts or last messages, things that you're focusing on right now, but I think we kind of hit on like the high level stuff, and definitely would love to have you back at some point depending on what's happening in markets, what's happening in the economy, what's happening with government spending, politics, the whole 9 yards.
Yeah, no, it's a good conversation. There's so much. I mean, I'm just a massive nerd on this stuff. I don't know why. To me, it's like the biggest puzzle in the world. I've always liked puzzles, so trying to figure out kind of global macro is like the biggest, most interesting puzzle. And so, yeah, I really like this stuff. I actually enjoy it. So, yeah, I would say, look, like there's a lot of issues that the U.S. finds itself at the center of. It's not going to be a quick transition. It's not going to be a painless transition, and it's not going to be a cheap transition. But things need to change, and this is coming at the intersection with AI and robotics that really throws a monkey wrench. That's very deflationary, getting to the structure of the monetary system that is anathema to. So there's a lot of issues, and it's all kind of coming to a head now. And then you look even outside of economics, outside of kind of finance. There's a lot of social, political, ideological, racial issues, right, within American society. And I think, I tend to come at things, the root of a lot of that stuff. I think the root of like 90-something% of these issues that we see permeating and kind of this cancer that has become our lives in America these days, I think it can be traced back to economics. And so that's generally my lens, or the lens that I view things through. And, you go through that thread that we were talking about, with all those posts. I think like every single post, every single chart that I've looked at points to the same picture. And, it's one that we've tried to defy financial gravity for decades. We've tried this kind of neoliberal globalist approach. I think that the pendulum has peaked, right, for globalization. I think that that pendulum has reached max globalization, and that will start to correct itself. I think that there's fundamental structural issues with the dollar, and again the valuation of the dollar in terms of gold, in terms of relative to other currencies, wages. That's a huge story, right? And then financial assets, you add that in, the disparity. Financial assets have greatly outpaced wages, and so yeah, the wage asset sort of story and outlays, as we were looking at, benefits, right? Like Medicare has grown 8 times faster than GDP going back to 1965. Like that's not sustainable, especially when the average hourly wage as a share of GDP is plummeting. So yeah, there's a lot, unfortunately, that's deeply wrong. And I just try to explain it in relatively simple English. At least that's the hope with the YouTube channel, and kind of what I try to, I took the time to understand the technical world of finance and macroeconomics and monetary theory and market dynamics and plumbing and all that stuff, right? But then I try to like bridge it to the average person, because I think that again, the first step is understanding the problem. We can't arrive as a country, and my only like purpose or motivation is a better country. Like I remember the 90s, and I think that was peak America, maybe the 80s into the 90s, right? And I remember it. I'm old enough to remember the 90s. I just want my country to get back to a place that I know it can be. And arguably some people say that, the 60s was even better, or the 50s, right? Like we know America has the potential to be the greatest country on earth. I think it just takes some relatively simple, straightforward policies, like prioritizing the needs of Americans over everything else. Like, I don't know, that seems pretty straightforward to me. And it's a change in mindset from the past 5 decades, but yeah, that's my only motivation or purpose behind it, is hopefully to educate, because I think education, once you understand the problem, I think that politically, hopefully, non-violently, hopefully the fourth turning stuff, right? Like this doesn't devolve into violence. This is not looking super hopeful, but if everyone's educated, right? If instead of coming home and watching the Dodger game, you spend 15 minutes a day educating yourself on this really wonky, complicated stuff, you start to understand what the problems really are. I think politically, especially young people, are, there is the potential for nonviolent sort of reforms that, just make America a better country.
Yeah, we'll have to wait and see on the next 5 or 10 years. I kind of have a feeling it's going to be a little bit of a circus. But before I let you go, I do have to ask my traditional closing question: is what book should I add to my reading list? Can be finance, history, or anything that you think would be interesting.
Yeah, Ages of Discord. We were talking. Fort Turning was fresh in my mind. Ages of Discord by Peter Turchin.
Okay.
Vastly underappreciated, underrated when it comes to that whole kind of world. Peter Turchin.
Yeah. No, I've been getting recommendations on, I think, his relatively new book, End Times. So
yeah.
been meaning to get around to reading that, but definitely we'll have to take a peek. So if the listeners or viewers aren't familiar with your work, your social media, YouTube, whatever it may be, where can they look for you?
Yeah, so on Twitter or X, it's at infra, INFRAA_. There's a blue check. I have all the spam accounts, make sure it has a blue check. And then on YouTube, it's Infranomics, like infra economics. Infranomics on YouTube. That's kind of where I focus most of my energy these days there, but I'm more active on X recently as well. So you can check out those. I go on X Spaces, so like if people ever want to DM or talk, come up in some of the spaces I'm in, have a chat, and yeah, I have an Instagram too, but for some of the charts. So what I do is I post the video, and then I take the slides from the charts from the video, put that on Instagram, and I think my Instagram's Infranomics _. So you can find the charts.
It's definitely worth checking out all those places. You'll definitely learn a thing or two. Very entertaining on social media, but I think people will definitely get a lot out of the discussion we had, and should definitely check out your work. So I really appreciate you taking the time this morning, and I think with that we'll be wrapping up. Thanks for stopping by, and we'll see you next time.